Bruce Edwards, and welcome to this podcast produced by the International Monetary Fund. Today, India's central bank governor talks about strengthening the global financial safety net.
What we have sometimes is a whole bunch of policies which make it more likely the safety net will be used, but then a backing off from responsibility to make the safety net whole.
Raghuram Rajan is charged with securing monetary stability in one of the world's largest emerging market economies at a time when many others are stumbling in the face of difficult global economic trends. Before becoming governor of the Reserve Bank of India in 2013, Rajan was chief economist at the IMF, where he worked towards enhancing the web of central banks and international financial resources known as the global financial safety net, and designed to help emerging markets manage sudden stops in capital flows. I met Raghuram Rajan in Washington earlier this month during the IMF World Bank spring meetings, where he participated in a seminar entitled Fortifying the Global Financial Safety Net. Why do we need a global financial safety net? And what can individual countries like India do to make sure that it's effective?
So I think two straightforward reasons. One, many of us are investing in long-duration projects like infrastructure. That requires a fair amount of external borrowing. And what you would like is long-term patient money. Now, oftentimes, emerging markets can't choose what kind of money comes in. And mixed in with that long-term patient money is a fair amount of short-term impatient money. And what happens is if sentiment towards the country changes, perhaps because of political developments, perhaps because of the external environment, interest rates are more attractive elsewhere, you find a significant outflow just overnight. These are what I think Guillermo Calvo called sudden stops. Dramatic overnight changes, and you wonder where it came from, why it happened. Sometimes you can point to a trigger event in the country. Many times it's trigger events outside the country. Some other emerging market has a problem. Suddenly people focus on the problems with emerging markets. Your competitor devalued in a significant way. People start focusing on whether you're going to be vulnerable and you're going to devalue. So things can happen. Stuff happens. So you need to prepare for that. Now, what you can do is build a whole lot of reserves. When the money flows out, people have an expectation that you will have enough to pay, even if global capital markets have stopped functioning for you. And that helps you protect the value of your currency. As a result, you don't have the typical bank run-like situation countries face. I'm going to get out before the currency depreciates even further. Let me be the first one out of the door, and you experience a bank run. If people know you have enough reserves, that you'll have enough to protect your currency, the exit becomes more orderly and sometimes doesn't happen. Of course, this is one way of looking at it. Some people say, no, let the currency depreciate. And, that's the true value. And so what if it overshoots a little bit? It prevents people from getting out because they say, whoa, it's gone down so far, so why get out now? So this is the old mantra that the multilateral institutions used to tell us: let the exchange rate be flexible. That should take care of most problems. Problem is that would be true if it was a fair indicator and stopped at the right time. But you see feedback effects. That as it depreciates, more people get wary, worried, depreciates even further, and doesn't necessarily give you the competitive edge, because unlike developed countries, our institutions aren't as credible. So when the currency depreciates a lot, we start getting higher rates of inflation. So, emerging markets aren't too confident about letting their currency depreciate a lot and would like to ensure that they have some way of managing that risk.
Do you think that the monetary policies of developing and emerging markets like India come under greater scrutiny by, say, the IMF than do advanced economies like the US, for example?
I don't think it's a practice that these are more scrutinized more than others. What I would say is that the fund is probably more influenced by innovations in industrial country policies and is more likely to believe those innovations are appropriate. While innovations in emerging markets are more attributed to the crankiness of the governor or the government, rather than based on a well thought out policy given the political and the economic environment. So there's a greater willingness to believe this is the right policy under the circumstances, and less willingness to believe that the circumstances justify the policies elsewhere.
So what do you think the role is of the IMF in terms of trying to effectively coordinate all the various aspects of the international monetary system? Is it up to the IMF, do you think, to sort of coordinate all the various elements?
I think absolutely. The IMF is the global multilateral institution which all of us tasked with the idea of guarding global monetary stability. And that means focusing on every aspect, including the reforms that are necessary to keep the global monetary system working. So I think the IMF is the legitimate guardian. It's the only one that all of us have in a sense empowered through the Articles of Agreement. I think it's important that the IMF continue to try to persuade countries to fill gaps in the global safety net where they are and when they occur. It's also important for the IMF to try and persuade countries to avoid policies that require the use of the global safety net. And what we have sometimes is a whole bunch of policies which make it more likely the safety net will be used, but then a backing off from responsibility to essentially make the safety net whole.
What do you think are the biggest gaps in the global financial safety net at the moment?
Well, I think that over the last so many years, as we've moved more from government to government finance and multilateral finance to market finance, we haven't kept up with the need for liquidity infusion to countries which have taken on a whole lot of market finance. Markets can turn illiquid, and so we need the provision of liquidity. And a global source of liquidity or a backstop to liquidity, that's what the fund is. And so to my mind, we have to see what we need to do to take the backstop into a fast-acting source of liquidity in the very short run, and how we deal with situations where that liquidity problem turns into a solvency problem. These aren't insurmountable problems. It just seems to me that we have to spend more time thinking about them because liquidity needs are fast, and certainly faster than the time to negotiate a fund program.
I know that you have been working hard in trying to bring more people into the banking fold using technology. Why do you think it's important for people to have access to these financial services?
A central aspect of financial stability has to be inclusion. There is no way you can justify a reasonably market-driven economy without spreading opportunity across the board. Eventually, the political opposition to that economy will rise if you don't have across-the-board opportunity. Financial inclusion is one way of spreading that opportunity. Now, technology helps. That villager sitting on top of a mountain in India with an account back in the valley doesn't have to walk down 10 miles and walk up 10 miles. Today, in fact, we just enabled this. They can make a transfer from their mobile phone to the shopkeeper's mobile phone from their account down in the valley, account-to-account transfers. That's technology. I think that's hugely beneficial.
That was Raghuram Rajan, Governor of the Reserve Bank of India, talking about the global financial safety net. You can watch the webcast of the IMF World Bank Spring Meeting seminar called Fortifying the Global Financial Safety Net at imf.org. You can also hear more podcasts like this one on SoundCloud, iTunes, or your favorite podcast app. Just search for IMF Podcasts.